Ghana's domestic debt exchange program and its impact on insurance. Before we start, let's take note of a few housekeeping rules. We would like to mention that this webinar is being recorded and will be posted on our YouTube page. Kindly, all participants have been muted. During the question and answer session, you can raise your hands and you'll be unmuted to speak. You can as well drop all your comments and questions in the Q&A chat box on your screen. A survey link will be put in the chat box for you to provide us with your feedback getting to the end of the webinar. To make the session more interactive, we have created polls for your feedback on issues in the industry. I would also like to acknowledge the presence of the country managing partner, Mr. Daniel Owusu. Thank you so much for joining us this morning. Without wasting much time, I'd like to hand over to the assurance partner, Mr. Kwabena Situ, to kickstart the meeting.
Thank you very much, Dorcas. Hope you can hear me clearly.
Yes, very clearly.
Okay, good. So you're welcome to this in fact, this is the first we are doing in respect of the 2023 Africa Insurance Outlook. And the Outlook has been running for some years now, but this year, we want to bring it home to Ghana to discuss certain things that pertains to Ghana. So this Africa Insurance Outlook 2023 contains very insightful thought leadership across Africa on the insurance industry. So the things we'll be discussing will cut across Africa, but we'll later zoom into what pertains to Ghana. This outlook gives you insight into what you should be thinking of as a practitioner within the industry, all right? And it also gives you heads up into some of the things that are likely to come in the near future. So very important, we are also bringing to light Ghana's own perspective, looking at the domestic debt exchange that happened, how it has impacted the various insurance companies in Ghana. So on this webinar, we will have experts across Africa. In fact, we are very privileged to have Andrew Warren. Andrew Warren introduced properly, but just to give you a brief of Andrew Warren, he is the whole of Deloitte Africa head of insurance. So we've been able to pull Andrew into this webinar. So you could imagine the various insights that Andrew is ready to share with us. And then we also have with us the country managing partner of Deloitte Ghana, Daniel Owusu. Probably you will hear from him at the later part of this webinar. So without much ado, I would like to hand over back to Dorcas to now take us through what next with this webinar. So stay back, relax, and enjoy this webinar. Thank you very much. Thank you, Dorcas.
Thank you very much, Kwabena. On the screen, we have Andrew Warren. Andrew is an actuary and director in the Deloitte Africa and has been with Deloitte since 2015. He is the lead advisory director for the insurance and investments management sectors for Deloitte Africa, and also the business unit leader for financial services advisory business. He has experience in senior executive leadership of insurance and employee benefits, healthcare and wealth management business, and co-founded and run a specialist actuarial consulting firm.
Sorry. Good day, everyone. Thank you very much, Dorcas. Thanks, Kwabena, for the introduction. I'm sort of really proud to be here and happy to join you and your clients and our clients in terms of launching the 2023 Insurance Sector Outlook, an initiative that I've been involved with for a number of years with Deloitte, and we're really proud as to where it's got to and where it's going. But today I've been asked to, as Kwabena says, give some perspective on where the industry is going, where your fellow industry professionals are managing their businesses into, and what is key for them as they craft their strategies out of the COVID world that we were in, and what is becoming important, what we're seeing globally and regionally in terms of the insurance sector. So I've covered it in 10 themes, but I think there's some sort of macro themes above that. And interesting enough, with the video that we've just seen, you might be intrigued to see why I put IFRS 17 in the bottom left and not the top left in terms of where we're at. And while IFRS 17 for a number of us, and particularly in the professional services firms, has been key in terms of what we've been focusing on, our clients have been focusing on making sure that they're able to deliver great services to customers in a way that the customers are demanding of them, as they change their expectations of insurers, as they've changed the way that they expect their product suppliers to deliver to them post-COVID, particularly in terms of how we've been able to digitize ourselves and respond to a number of key trends inside and outside the insurance sector. So one of the key things that we are seeing is the drive to make sure that the industry, which has survived incredibly well under the stressful scenarios of the COVID pandemic, both in terms of the life and health businesses and the short-term insurance or general insurance businesses, is getting back into a growth mindset. A lot of time was spent focusing on protecting the sustainability, the solvency, and the operations of the insurers through a very trying time. But as you may have seen in the outlooks that we've produced previously, our analysis of the industry on the continent, and particularly in terms of where the main listed insurers are in South Africa, we've seen a high amount of resilience that the industry was able to demonstrate through that period, and that the balance sheets and the solvency that underpins the promises that insurers make in the market is held up during COVID. But now the insurers have to now focus on going into a growth mindset. They need to focus on getting customer acquisition back on track and optimizing their delivery. And I think optimizing the distribution, and that is key in the intermediated insurance market that we operate in, is that our distribution partners as insurance practitioners are absolutely critical and a critical component of the offering that we've got. They provide the servicing interface, they provide the advice interface to ensure that customers get what we promise and that they're comfortable and confident what they get. The optimization of distribution has meant that we've had to partner as an industry with our distribution businesses to make sure that they're able to respond to the digital transformation that's happening, and I'll talk to that now, but often with far less capital and investment capabilities in terms of the costs that digital distribution comes with. So the partnership model with distribution, actually focusing on digital distribution and bringing that to the distribution partners, has been critical to achieve the growth that's been getting. And we've been seeing that across our markets and across the shift of the strategic themes from looking inwards to looking outwards. At the same time, insurers have had to manage their persistency. I think some of the elements that came through from COVID was that customers became much more aware of the importance of the insurance products that they held. And so we did see an element of the market that managed to maintain their customers more. But as the market starts opening up and starts getting growth, the growth mindset kicks in. It is a highly competitive market, and particularly in low growth economies. And South Africa would be one of those, and there are a number on the continent that are struggling to get broader economic growth. A growth in that market requires taking market share from others, and that means in order to defend against that happening, managing persistency has become key, and the data elements around that to understand our customers has become much more important. In those markets where growth is difficult to come by, and we're struggling to win market share, and this is within market segments in markets as well as the markets as a whole, the focus on cost and efficiencies is coming to the fore. So we're seeing a number of programs being run to have a look at the way that our business has been built, starting to look at the legacy environments that insurers naturally create from the perspective of our products. We have long duration products, and over time, those accumulate into lots of different product configurations or product types. And we're starting to see more focus on the cost of a declining book of old products and how insurers can actually bring those together. So we're working with clients to look at their book of business and make sure that in putting cost efficiencies on the table, it's not just around cutting costs in an established environment. It's actually looking at cutting costs in an environment where we're actually changing the product constructs, and we're seeing that come through. And that then opens up avenues for modernizing and digitizing the customer interfaces and getting digital transformation that is looking towards the customer, bringing the customer into the servicing and sales network through interactions from a digital perspective. And the opportunities that are opening up, particularly starting in the broader global market, but now moving in a smaller scale onto the African continent through the cloud environments that enable syndicated digital transformation, if I use that language, to make sure that we can get the same level of technology and data capabilities that are available in the large insurers globally, and we're able to bring those through into our markets, where the market is not as big, but the opportunity to transform our markets is the same, with the enablement of digital transformation of the business. Linked very closely to that, and we're seeing it quite active in the African market. And I think we're leading the market globally in terms of the convergence of industries and the embedding of insurance models across other industries. And a really good example of that is the MTN Sanlam Alliance that is starting to pick up, bringing MTN's financial services business actually into mainstream insurance. So I think one of the things that insurers are seeing an opportunity in, but are also worried about, is the extent to which the future competition in insurers is not necessarily going to be other insurers, but that retailers and mobile network operators, particularly on the African continent, and in more from a European and Northern Hemisphere perspective, the motor manufacturers are actually embedding the insurance product deep into their own products, and are delivering what the client needs in terms of a protection product in line with another product that's in place. So the partnerships, the ecosystems that are being built across industries becomes a critical component of what we're seeing emerge from insurance strategy perspective. The underserved segment from a market perspective is an interesting one, and particularly from a South Africa perspective, where we have quite a disparate market from a consumer perspective, and the imperative to look at the underserved markets from a financial service perspective has been very much a South Africa and I believe an Africa story as well. But what we're now starting to see actually is that the global insurers are starting to see that there are underserved segments in their market, and that the penetration of insurance as a critical social good is really important from the perspective of their strategies. And it aligns to the shift to really being customer-centric and understanding what different segments of the market need. It aligns to the growth opportunities that exist where insurers traditionally haven't looked at markets that they felt were not servable because the economics or the distribution mechanisms weren't available to them. And in doing that, they're able to start closing the protection gaps. And so the trend here actually, I think, is from work that is already happening in our markets and the market that you're in, into actually starting to see that emerge more actively in what would be saturated markets in Europe and overseas and broader globally, to make sure that the market is served to the point that the insurance product, which we understand is a really important social product, comes to play across the world. So getting that and bring that through becomes really important. As we start looking at the themes that are emerging globally, the sustainability discussion and particularly the environmental risks that are emerging from climate change are starting to worry society at large, and that organizations like insurers are becoming much more aware of the impact that they have on the environment and that the environment actually has on their businesses. And so the trend towards understanding the impact of climate change and broader societal changes on the insurance market is a very strong theme in the regulatory space at the moment. And while we hope it's not as invasive as something like IFRS 17, it's definitely going to be more as impactful to insurers. The Insurance Alliance that was formed out of the COP that was held in Scotland has unfortunately started to unravel, partly because of the competitive pressures that emerged from the US. So I think the hope of a group of large insurers actually driving some of this in collaboration is now going to be changed into the large insurers and the local insurers, focusing on what their role in a just transition starts looking like. And what we're seeing is two themes emerging from this. One is looking at what the impact of the insurance industry is on climate change. And that looks at the kinds of products that we're building in the investment space, the extent to which our financing is starting to tilt towards those elements of the economy that drive the environmental change, as well as the impact on things like insurance contracts that are able to insure projects, particularly in the general insurance space and the commercial line space, insure those projects that are looking to change the way business interacts with the environment, the lived environment, and how the impact would look for consumers. The other side, and it's where the regulators are looking a lot, is, well, what does the overall economic shifts that are driven by climate change do to the balance sheets of insurers, to the sustainability of the long-term promises that we make? And understanding the scenarios under which those emerge becomes really important for both the insurers and the regulators to understand where that systemic risk comes in. And I'll talk to it a bit later, just in terms of the role that risk-based capital frameworks play in making sure that the scenario-based analyses that are available to insurers come to the fore in the way they drive their strategies. Yeah, we saw in the opening videos that the IFRS 17 is still very much alive and well, and I think the disruption to the finance and actuarial teams has not been has come through very much more than the expectation originally. The operationalization of IFRS 17 is now critical. So most insurers understand the impact from a numerical perspective of IFRS 17, but it's now coming down to how the finance teams, the actuarial teams, and other elements of the operations of insurers going to need to embed that into the business, and how do insurers actually start getting returns on that? And there's strong evidence that the information coming out of IFRS 17 is now starting to is going to deliver dividends, but it's going to take time before shareholders, other stakeholders, and management are really comfortable that IFRS 17 is a reporting and performance framework that gives information to run businesses effectively. And then the last point that we're seeing, and that globally in industry as a whole are grappling with, but in the insurance industry specifically, is around the workplace strategies and culture as the talent war intensifies. So we recognize that insurance is, in some respects, quite a difficult industry to enter into from an employer perspective. There are other more appealing ways to enter the labor market in terms of where digital and technology are playing. And so the war on talent and fighting for the quality of resources and the skills that we need to drive our business becomes critical. The strategies around what it means to be in a hybrid work environment is still something that's taxing financial services companies and insurers. And we're still seeing experimentation happening in terms of how much at the office, how much hybrid, and how to make sure that we are still serving our customers with the staff that we've got. And so those give us the key themes if we sort of have a look at it in terms of where the industry is going. But if I look at two of the sort of sub-themes in there that are referred to, but I want to unpack a little bit more, is IFRS 17 and risk-based capital regulations. So 20 years ago, the industry started on this journey, or the accounting profession or the reporting profession started on the journey of trying to get to a framework that would give a view of the insurance company's performance that's both in line with other reporting frameworks for other industries, including banks and other service providers, with very difficult product configurations. If we look at where we are right now, we were given a 2-year extension, which was really important because I don't think we would have been ready 2 years ago. But the listed African insurers are now actively running their businesses under IFRS 17. We are waiting to see the 2 big listed insurers with a December year end produce their interim results for 2023 in the next couple of weeks and see what they're bringing to the table. We know that what they are facing with are some teething issues around the actual running of their finance and actual teams on the systems that were tested over the last few years. The mid-size insurers are likely to be ready for the first reporting season. They've got another 6 odd months. Our general working with them, the auditors have been engaging with them, the frameworks have been set up. They have much smaller books to report under, but they're more likely to be ready. And it's the smaller insurers who are now looking for tactical solutions, effectively looking for ways to get through the next 6 months. And the assistances that are being given are around actually, in some ways, outsourcing elements of the reporting requirements, at least in the interim, to groups of individuals who are able to do it quickly and effectively. And so we still have a little bit to go in terms of the journey. We will see the information coming out of IFRS 17 becoming more familiar, an understanding of how the IFRS 17 revenue and cost framework starts giving us an idea of performance. And over time, having spoken to the investment analyst community, and a much greater appreciation of what is expected of insurers from a targeting perspective when looking at the IFRS performance frameworks and how those would tie up relative to potentially banks that they are parts of or other companies in the market. The next shift, and we're seeing it having looked at what's happening in the market, and I know it's a key theme from a regulatory perspective, is risk-based capital regimes. Looking back, and we've done some retrospective in the insurance outlook around risk-based capital, and the journey that the South African market had, having adopted risk-based capital off a Solvency II framework. And that gave a head start for some elements of IFRS 17 because the modeling requirements were very similar. So we do expect that the reverse now happens, where the risk-based capital framework follows IFRS 17. And so while the South African insurers, if I look at it as an example, had some kind of head start because elements of the IFRS 17 framework were already part of their environment, we now can expect that the foundations built to comply with IFRS 17, particularly in the actuarial space around the modeling and the way that that needs to be reported on, can be brought into risk-based capital frameworks, at least at the Pillar 1 level from a quantification perspective. But we know that risk-based capital is not just about the numbers, it's also around the governance framework and the communication framework. And so the key factors we've identified from the journeys that we've seen and what's happening from a successful implementation and utilization of risk-based capital is strong industry involvement and collaboration with regulators. And I believe that is a common theme across all territories where they're looking at it. It's not happening without industry involvement. But it also is happening with a full appreciation of the time and effort that's going to be required to implement the full frameworks that exist in the EU and in other territories that have got similar frameworks. The quantitative and qualitative impact studies are something that I think we missed in IFRS 17. So we didn't have an opportunity to to do enough dry runs and to test what it could look like and potentially give feedback into the mechanism. The global IFRS 17 framework did not enable us to do that. The localized risk-based capital frameworks enable industries in territories to be able to have a dialogue with quantitative and qualitative studies, and the number of those being produced will actually give good insights. This upskilling of practitioners, and it links to the talent, the fight for talent becomes key, but also making sure that the information flow across both the industry participants, their boards, and other stakeholders is key. And then, as I say, using the IFRS 17 transitional learnings. So overall, I think from a perspective of where we're seeing the insurance industry, we're starting to see some really good growth in terms of, so at an overall level, looking at good growth from a customer perspective. The regulatory overlays are starting to become more certain. So I think there's some time to actually take stock of where we're at and be able to optimize our businesses. But in all, making sure that what we're delivering is focused on what the customers are looking for and how they're wanting to engage with us. So that's what we're seeing. I hope it was insightful. We will be happy to take questions later, but I'll hand over back to Dorcas to take us into the regulator to give us a view of what's happening at the Commission. Thanks very much.
Thank you very much, Andrew. Thank you. All right, next we have Michael Kofi Andor. Michael has worked with the National Insurance Commission Ghana since 2000. He was the head of supervision from January 2006 to September 2017. Currently, he's the acting commissioner of insurance. Prior to joining the NIC, he worked 3 years with KPMG. Mr. Andor has been involved in a number of projects to develop the insurance market and improve access to insurance in Ghana. He has been actively involved in the design and implementation of a risk-based supervisory framework for the Ghanaian insurance industry. He has also played a leading role in the design and implementation of Ghana's inclusive insurance regime. Mr. Andor is currently a member of the Insurance and Pensions Advisory Board and Program Leader, Toronto Center. So I'll hand over to Michael.
Thank you, Dorcas. And let me try to share my screen. Okay. Okay. You can, Dorcas, can you see my screen?
Yes, please. I can see your screen.
Okay.
Okay.
Okay. Thank you, and good morning to everybody. So my brief presentation will talk briefly about recent development in the Ghanaian insurance industry. We'll look at how DDEP has impacted the industry, and we'll look at the outlook, which is where we will dwell for some time, the insurance outlook for the Ghanaian market. So our industry, as most of you may be aware, is quite small. Gross premiums, annual 2022, about 6.5 billion. Management expense, okay, assets about 12.2 billion as at end 2022 in cedis. Okay, now the regulated institutions, we have about 46 insurance companies, and here they are analyzed according to the local and foreign ownership, but there are about 26 non-life and 20 life companies. We have 3 reinsurance companies. So adding the 3 reinsurance companies makes it about 49 companies in all. Now, what are some of the developments that have taken place in the industry over the past few years? So we have seen the implementation of the new minimum capital requirement, which have seen the minimum capital of insurers going from 15 to 50 million cedis. This actually became effective January 2022. And then we also saw the banking sector cleanup, and that also impacted the industry, created some initial liquidity challenges, but has created some solvency challenges as well for some companies, because not all the investments that were involved and the funds have been fully restored. As most of you are aware, there was a new Insurance Act passed in 2021, Act 1061, which changes a lot of things and has levers or buttons for growth and improving the efficiency and capacity of the industry. And of course, we had the DDEP coming in, and we will look in depth, a bit more in depth about DDEP even as we go along. So as at December 2022, the industry's holdings in Government of Ghana securities was a total of about 6.3 billion, and about 1 billion out of that had been impaired. I mean, at least according to the audited financial statements that have been analyzed so far, we have about 1 billion impairment losses recorded. So this has impacted profits and solvency of the insurance companies as at end 2022. It's also affecting the policyholder value losses because of the effect of the impairment losses and the mark-to-market principle that the Securities and Exchange Commission actually issued a directive on for all the investments and fund managers to apply to the various investments that they hold. And so this has resulted in some policy holder value losses, especially on the life side. And there are some complaints and some trust issues that are emanating from there that we need to deal with. Now, DDEP also probably drew clear attention to something that has been there, but probably has not received enough attention. So those of you who are familiar with the financial statement of Ghanaian insurance companies will realize that the companies mainly make underwriting losses and depend on investment income to break even or make profit. It has been so for some time, and it has been so for a good majority of the insurance companies in Ghana. Now, the reliance on these profits is becoming questionable because the risks, the investment risks are now showing up, and we can't be sure that we could be recording the kind of returns on investments that we have recorded in the past. And so as this happens, it means that we need to begin to see how to realign the underwriting so that we can generate some returns from there and not rely exclusively on investment income. Another thing here has been the over concentration on government securities. I mean, most of our investments. So If you take the total investment as at December 2022, close to 60% of the total investment on insurance companies' balance sheet were in Government of Ghana securities. And that's another lesson that has come out, that there is the need to diversify and of course to manage the risk. Another big thing that came out is a lesson on the so-called risk-free asset. We know that the assets we've been calling risk-free are really not risk-free. And so there is the need to recalibrate the solvency framework to guide insurance companies to constitute their investment portfolios appropriately in a way to diversify and manage their risks well. So, so much about DDEP. I'm sure someone will talk extensively about it later on. So, to help companies to cope with the impact of DDEP, the NIC, and indeed all the financial sector regulators did come up with some regulatory forbearances. And in addition to that, there is a solvency fund that the government is setting up, hopefully to help the companies that to meet the capital and solvency requirement, some of which have been impacted by DDEP. And so these have been announced to the industry, and some of them are already in practice. So the outlook, insurance outlook, I can see this talks largely to the slide that Andrew also dwelt on for some time. And so as where we are at the moment, in my personal, not official, in my personal view, there are three things we need to do. We need to stabilize the industry, we need to strengthen the industry, and then we need to develop the market. So capitalization, hopefully through the solvency fund that the government is setting up, will help to stabilize the market and help the companies that need additional capital. So that's something that discussions are still ongoing on, and I'm sure at the right time, the necessary announcement will be made and the procedures will be laid out, and we will see how the industry benefits from that to help it to stabilize and to meet the prudential requirement. The NIC is also discussing strategic approaches to addressing the underwriting losses. We need to improve the efficiencies, the operational efficiency, and the underwriting gaps or weaknesses that are leading to the losses. We need to begin to take a strategic approach to that. And there are some discussions. And again, in the not too distant future, the NIC will come up with some clear roadmap on addressing the underwriting losses and help the industry to become efficient and robust. Andrew did talk about risk-based capital, and yes, we have been working on risk-based capital for some time. I am happy to hear him say that it's important for the RBC framework to follow IFRS 17, and I'm happy that we are also working on IFRS 17. And as it is, there is the opportunity for us to design or shape our RBC framework based on the IFRS 17. And so there is work going on risk-based capital, and there's a plan. There was an original plan to implement this by 2025. So that's still work in progress. IFRS 17, we were working very hard towards IFRS 17 and we got disrupted by DDEP, and DDEP became the burning platform that demanded attention immediately. And so it did get all the attention. And now that the dust seemed to be settling on DDEP, we've gone back and we started or resumed the preparations towards implementation of IFRS 17. We have had a workshop and a second one for the actuaries and the finance officers. And the second one is scheduled for the first week of November. We also have sessions planned for the CEOs and the directors of the companies. And yes, we do have challenges, we understand, considering the time left and the amount of work, the enormity of the work left to be done. But we are hoping that our 2023 account will be IFRS 17 compliant. All the challenges notwithstanding, we are strategizing, and we hope that with the help of consultants, Deloitte, we will be able to guide the industry and facilitate the implementation. We do also hope that the Institute of Chartered Accountants is because there must not just be the capacity to comply, there must be the capacity to audit. So I do hope that the ICA is, and that's a conversation that we actually need to have with them. ICA is working towards building the capacity of the auditing firms to be able to properly validate the compliance with IFRS 17 as well. ESG framework, again, something that Andrew touched on, environmental, social, and governance issues. Now, a lot, sustainability is becoming a very big governance and boardroom issue. And it's rightly so, because one of the biggest risks that we face is climate change risk. And we need to begin to take proactive steps to address them. And so the NIC is working on an ESG framework, and soon we will begin to engage the industry on it, on the various facets and the requirements and the roadmap and what exactly we seek to get the companies to do in their to incorporate this into their strategies, into their underwriting, into their financial reporting, into their business as well. And so that's something that is also cooking. And I did mention earlier on that we have a new Insurance Act passed, and we are working very hard on the regulations to that. So it's a three-piece legislation. We have the Act, then we'll have the regulations, and then there will be the directives, which will be the technical details, which will actually be issued by the NIC. So the work on the regulations is almost done, where we will be going for parliamentary approval sometime soon. And the directives are also work in progress. Another area Andrew talked about is digitization and innovation. And yes, those of you who have read the Insurance Act will see that there are some provisions in there to promote digitization and innovation, mainly to facilitate growth and efficiency in the industry. And so, for example, we do have a sandbox system. We do have a sandbox system which we are working around. We are developing the regulatory requirement for, and we are seeking to introduce tech platforms where we have interactions with the fintechs and the insurtechs and to discuss issues which or challenges which may need tech or innovative solutions and some other issues. So digitization and innovation, again, is another one that we are working on. And of course, the development of the market. There are some compulsory insurances in the Insurance Acts that we have been working on. For some of them, we have already formed committees with representatives from the GIA and the relevant stakeholders we have the view that taking a consultative approach is better. I mean, just because those insurances are compulsory doesn't mean we could just go throughout anything at the people, but if we liaise, collaborate with them and develop something that meets their needs, we could actually make a better use of it than. So we are actually consulting a lot of stakeholders and coming up with very sustainable frameworks for implementing the compulsory insurances. We are also working with stakeholders to improve our agricultural insurance. And we have been working on our inclusive insurance market for quite some time, but we are switching focus to micro and small businesses. And that's the next phase of our inclusive insurance development. So basically, that's the outlook as I have it for you now. I'll stop here for any questions that you may have for me later. Thank you.
Thank you very much, Michael. Thank you for the presentation. So up next, we have Richard Omari. Okay, so Richard Omari. Richard is a senior manager in the audit and assurance unit in Deloitte, Ghana. He's a chartered accountant with over 10 years of experience. He's a member of the Deloitte IFRS experts, having worked with the Deloitte IFRS Center of Excellence and part of the Deloitte Africa Technical Assurance team. Richard specializes in the application of IFRS for financial services industry and an expert in insurance and financial instrument accounting. He's a facilitator in the Deloitte Ghana IFRS Academy, which has trained several individuals and clients across all industries in Ghana, across Africa, and Europe. He has a wealth of experience in the application of IFRS to technical accounting issues. So, Richard, over to you.
Okay, thank you very much, Dorcas. Normally, such introductions create a lot of responsibilities. Let me quickly share my screen. Please let me know if you could see my screen.
Yes, we can see your screen.
Okay. Presentation. Okay, so thanks everyone for joining us this morning. The interesting bit of this presentation is that the regulator, Mr. Ando, has actually touched on most of the interesting aspects of this presentation, especially when it comes to the domestic debt exchange program that we have experienced recently in the country. So just to do a quick overview. So we were coming from quite a stable political environment recently. And then what was happening was that the insurance industry was seeing some great improvements and some great growth, to the extent that we recorded a significant increase in premium revenue, as the regulator highlighted. From research, we realized that from 2018 to 2022, premium revenue within the industry grew by over 232%. And that is up to the 6.5 billion as mentioned by the regulator. And then fast forward to 2020 to 2022, we also experienced some economic challenges in the likes of COVID, the Russia-Ukraine war. Only God knows when that war is going to end. And then we saw a serious hikes in our inflation last year, 2022, to the extent of getting to 54.2 as of December 2022. We have also experienced unsustainable debt levels and then significant depreciation of the Ghanaian cedi in the past year. Then the government came up with certain strategies to stabilize the economy, and that the government went in for the IMF bailout. And out of the bailout came the domestic debt exchange, which has become the talk of the day any morning when you wake up and then you open to your radio. This is just the premium growth. Now, what has happened in terms of the impact of this DDE in the insurance environment? The regulator has mentioned some of them, and just to touch on quite a few of them. What's as actually had intriguing is the fact of liquidity risk to the insurance industry. And the reason is because of the new terms of the new bond. What is happening is that recoverability of the cash flows are going to be extended up to 2038. And what it means is that a lot of funds are going to be locked up with the government and the insurance industry. And from on the slide, on the chart to my right, is the result of an investment incomes as compared to other forms of incomes. And you could see that in the insurance industry, investment income is playing quite a significant role in the industry. And hence, for all these income vis-a-vis the capital to be kept by the government for this while, what it means is that we are going to see a significant liquidity risk in the insurance industry in the coming period. And to that, what we would want you to be, and to that, the NIC actually brought to form some regulatory forbearances. I saw someone posted in the chat box, what are some of these? And the most interesting one is the request to postpone the implementation of IFRS 17 to 2026, which was, do I say happily or regretfully declined by the Institute of Chartered Accountants, to which that there wouldn't be any standard to apply to, and hence we must still comply with. Means that IFRS 17 is still coming into force. And then the NIC has also placed some moratorium on the meeting of the minimum capital requirement and the capital adequacy ratios. And then NIC also came up to say that for initial 2 years, regulated entities must follow specific guidelines to demonstrate the ability to pay claims and then expenses such that they can be supported by the regulator. And then NIC fees that have also need to be reduced such that entities or the insurance businesses can be in business. And then also the regulatory assets may be allowed to, insurers may be allowed to create what we call regulatory assets to fill in the gaps caused by the debt exchange and write them down over a 15-year period. So these are some of the forbearances that the regulator brought about. And for the losses, the regulator is saying that entities may have the opportunity to write off their loss over a period of up to 5 years for some companies. And then also, there were some revisions when it comes to claims payment timelines. For non-life entities, you have between 5 to 15 days to make sure you turn around your claims. And for life, you have up to 15 days. For non-life, it's 10 days, and for life, it's 15 days. Sorry for that mess up. And then release up to 50% of minimum capital, up to 50% minimum of your statutory deposit with the regulator. You have the opportunity to release that into the business to ensure that you are operating actively. So in the next steps and then the way forward, we see that though we are still in early stages of the DDEP, we still see a potential long-term impact on businesses, or especially the insurance industry. And then what we also saw is that while the program is expected to alleviate the country's debt position, it is going to create, or it's creating heavy burden in terms of impairment on investments for the industry. And hence, insurers are encouraged to take advantage of the regulatory interventions or explore other alternative investment choices. Then what we also come up with is that the debt exchange program has underscored the importance of insurance companies having diversified investment portfolios. So it means as an insurer, now when you are making investments, you shouldn't place heavy reliance on the government facilities because you don't know what is going to happen next. To that said, what we are thinking of is that when we venture into the RBC risk-based capital and then come up with a risk-based pricing approach, we are likely, or the industry is likely to mitigate the impact of such instances when they should happen in the future. So on this note, we'll pause here and see if we have questions. This is just a brief overview of what the debt exchange has brought, and then what our considerations are in the next steps for the industry. So at this moment, we'll just break and then ask for questions. So Dorcas, you are welcome to help me out in the chat box if there are any questions in there.
Okay, thank you very much, Richard, for that very short presentation. Okay, so Michael has his hand up. So Michael, if you can unmute and speak.
Yes, thank you. So I see in the chat box a question on alternative investment that insurers can explore. That's a difficult question considering the economy as we have it now. But I know that there are not just effort, work is going on to diversify the investment market. I know that there is work going on commercial papers, and all the stakeholders, the SEC, the Stock Exchange, the Investment Securities Association are working to develop various kinds of commercial papers. The main objective is to channel funds into production, private sector into production, from government securities into production. So this is going on, and very soon there will be a lot of information. There are very, I wouldn't say strict, but very efficient guidelines and controls around them to enable the funds to be appropriately managed and controlled. There is also work to develop the bonds market. Currently, we do only have the government of Ghana bonds. There is work to develop the bonds market to increase the nature and the variety of the bonds that we have, so that we can invest in. There's actually the investment market master strategy that is being implemented, and a lot of work is going on that. So currently, yes, we or at the moment, there doesn't seem to be much, but in the near future, I must say in less than a year, I am sure if the current ongoing work continues to whatever logical conclusions, there should be soon alternatives to enable insurance and other companies to invest appropriately. Thank you.
Thank you very much, Mr. Ando. And that's an interesting one. Yes, I see someone asked in the chat box, and this is coming from Charles. Has the GDP made the implementation of risk-based capital more challenging? And I think this one will go to Mr. Ando.
Yes, it's I don't know whether I should say more challenging, but it's made very useful input. Because risk-based capital looks at the perceived risks in the various assets, and as you know, the risk dynamics of the assets as we have them are quickly changing, and so yes, it's going to affect the risk factors that are going to be used to do the calibrations. So yes, it will impact it, not necessarily making it more challenging.
Okay, thank you very much. There's a question surrounding tax, but before maybe Mr. Ando, you come up on the tax. Andrew, let me put you on the spot here. When it comes to the tax regime in the light of IFRS 17, what is happening out there? Do you have any perspectives in South Africa? Hi, Andrew.
How did we drop off?
All right. So Andrew, there's a question in the chat box concerning what the NIC is doing in terms of tax.
Yep.
But before our regulator comes in, I wanted to find out, do we have some perspectives from the South African jurisdiction in terms of what the SARS is doing?
So I can jump in there and just talk about the transition. So
Okay.
so we obviously, and then there's the global stuff is all about the global tax. But Michael, happy to jump in first, give an indication of what SARS has done, and then you can jump in from an NIC perspective.
Okay, please go ahead.
Sorry, thank you. So I dropped off, and so I thought I was back in a side room. So thanks. The questions around tax. So the South African tax regulator has been engaging with industry for a couple of years, particularly around the determination of the liabilities that are going to be used for the tax basis. So we have a trust-based tax basis for savings products. It's important that we get our liabilities right. So those have been done over the last few years, and the Taxation Laws Amendment Bill or Act was put in place last year to allow the transition. And then the tax regulators then also allowed a transitional period for the income statement tax changes between IFRS 4 and IFRS 17, or that are transitioning the tax liability across. So it's been work in progress for a while, and the industry is now pretty much ready for it, and I think not uncertain around what the impact is. So apologies for the sidebar. I was locked off the call. I didn't appreciate everyone was on the call at the time. Apologies for that.
No, that's fine, Andrew. No, that's good to hear from what is happening from the South African perspective. Maybe Kofi, you want to come in, but before you come in, let me also acknowledge the presence of Giles Woa, who is also an actuarial director, partner in Deloitte. And then I have a director, Katleko, also joining the webinar. So we have a full house of IFRS 17 experts and IFRS 17 and insurance experts in the house. So, Mr. Ando, please, what has the NIC been doing vis-a-vis the tax implications of IFRS 17 in Ghana?
Okay, so the responsibility for that is that of all the stakeholders involved. IFRS 17 was brought down on our heads by the International Accounting Standards Board, represented by the ICAG in this country. So yes, there is the duty to synchronize the IFRS 17 financial reporting and the tax laws. And it is important for all the stakeholders to come together to deal with this issue, the NIC, the ICAG, the GRA, and all the other stakeholders, so to deal with this. There was an initial encounter with the GRA, and what the NIC has been doing is build capacity for the insurance companies to comply with IFRS 17. And at one of our workshops, we brought the GRA there to have the discussion, to see the implications and how adjustment need to be made to accommodate this. But moving beyond that, the NIC is planning to set up a working committee made of all stakeholders to decide or to discuss the issue of all the issues that are that IFRS 17 brings up. Tax is just one of the issues. There are many other issues that IFRS 17 brings up, and the intention is to set up this working group made up of all the stakeholders so that we can resolve some of these issues. And we hope that we will be able to not just hope, but we will find solutions to the tax issues from the work of this working group and the discussions that will ensue. I see questions on the 5 days
the timeline changes, the clean timeline.
Well,
yes.
So the issue there really was to help the companies mitigate liquidity challenges. Okay, so it's exactly what it is, because we knew that the DDEP could bring liquidity challenges to the companies. So buying time was just for them to find the resources to pay the claim. So so that is exactly what it's intended to be. So it's to help them to deal with the liquidity issues, so that they at least when you give them 10 more days, it will be easier for them to find the cash to pay the claim than in 5 days. That was the intention.
Okay,
what has been driving?
Okay, so I think you have a lot of questions to answer, Mr. Ando. So one question from Mr. Yerebiakwa is, what has been driving the underwriting losses of the industry?
Yeah, a lot, and there's undercutting that is charging below the economic rate for the risks that the companies carry. There are inefficiencies, operational inefficiencies. There are increasing operational costs and some other reasons, all accounting for it. Acquisition costs. You see the cost of acquiring the business, especially on the intermediaries, going up very high. And let me also say that generally, the size of our companies is also an issue. I say that because in the insurance sector, a lot of costs are fixed. And so whether you are a big company or a small company, you have to cover those costs. So if you are not big or bigger than a certain size, it becomes difficult for you to cover those costs and of course break even and make profit. And most of our companies are small. I mean, compared to our peers in, say, Nigeria or South Africa or Kenya, you will realize that our companies are very small. And so that structure challenge is also there, that below that size, it becomes difficult to break even and be efficient. So there are a number of issues that contribute to the underwriting loss. But like I said, there are discussions to look for strategic approaches to dealing with those. So we will bring that discussion to the industry and maybe to all the stakeholders at the right time.
Okay, thank you very much, Mr. Ando. So there's another one from Frank Offe justice. The commissioner mentioned that the commission is working on a framework to target small and micro sectors of the economy. Can the commission take inspiration from the banking sector that has different licenses with different MCRs for the rural banks and the universal banks? Wow, that's an interesting one.
Yes, an interesting one, and it doesn't come without risks. We all saw what the microfinance and those entities, the problem they created for us. The financial sector cleaning program was all about that, to deal with the consequences of having all those entities. I don't know whether we had the resources to efficiently regulate all of them the way they should be, but that is the downside of it. And so, yes, it's a possibility, but we need to think through it carefully. We need to assess the risks and make sure we have the resources to effectively supervise those entities once we create them, and to mitigate the risks that they bring to the market.
Okay, thank you very much. Okay, so I think he also asked that, and I think this is on the alternative vehicle. But before I take the alternative vehicles question, I understand Giles wants to say something. So Giles, if you can unmute yourself, let's hear you.
Let's just check.
Hello,
Yeah. Just to check. Can you see me? Can you hear me? Yes, that looks.
I can hear you, but I can't see you. I want to see your face and then your voice.
It claims that my video is working, and I can see myself on screen.
Now I can see you too.
There you go. Okay, good. Kofi, nice to see you. Hi. Good. Good afternoon. Good afternoon or morning, everybody, depending on which time zone you're sitting in. So I'm not sure I've got that much more to add. The big issue of the day, issues of the day being IFRS 17 and DDEP, they're sort of ongoing. I still think the outworking of the DDEP is ongoing. Because the market in the replacement bonds has not been liquid, or at least what I've seen so far has not been liquid, that I think there's some additional pain to come through, because companies had to select a discount rate to apply for assessing the impact of the bonds. So there's going to be, I think most companies opted for the lowest discount rate. But if, as it seems to be the case, that investment rates prevalent to the market are somewhat higher, there's some additional pain to be experienced. So that's going to be an ongoing issue, and I think companies are still having to work out, well, if they're going to move to a mark-to-market basis, and when will the market be deep and liquid, and what are they going to do with the impact? I suppose a question will be ongoing is the industry as a regulator ready for that additional impact to come through? Because it's going to be somewhat hidden now. It was clear what was happening at the end of December or beginning February of this year, but now the waters are going to be muddied. So it's a big challenge for the industry, for companies that operate the unit-linked funds. How are they going to pass on those additional losses to, if I'm right, to policyholders? So it is an ongoing challenge, I think, for the industry, and it will come through in the half-year results. It will come through further in the year-end results. So it's not just a single shop, but a multi-layer shop, I think.
Yeah. Maybe, Sandro, you have anything to add on? But maybe let me read Justice's next question, because it's also in relation to, because he's saying that he believes that the regulator can help with the rating of entities for which the insurers can invest in, so that they avoid what happened in the financial reform sector and then the DDEP. So in terms of managing the risk coming from the investment side. So, Mr.
Yes, yes, indeed. I did mention that earlier on, that we need to recalibrate the solvency framework. And that's what I meant. The risk rating of the various investment assets, we need to take another look at it, based on the lessons we have learned from the DDEP. So yes, that's something that we need to do. So that's going to happen. With respect to what Giles has just said, yes, it's a challenge. It's a big challenge, because that creates problems for policyholder values and benefit. And we already have started receiving the complaints, and we may have to sit down and draw some framework around this, because yes, we understand that the asset values have gone down. We understand there are mark-to-market issues, but we need to have a way of fairly applying it, so that we don't treat the policyholders unfairly and cut down on their benefit unfairly. And so we need to have some framework around reflecting those. Some of them are actually temporary losses, and until the policyholders are actually surrendering or withdrawing, those losses have not actually crystallized for them. So we need to draw some frameworks around them, so that, because already insurance is based on trust, and if we don't manage this well, we will worsen the trust issues that we have already, and it will bring the market down. So I understand just the challenges that you allude to, but we need to carefully manage them, so that we don't create bigger problems for the industry.
Thank you very much. So I think I see a lot of questions around the investment, mix of investment, but there are also other interesting areas when it comes to the questions. So let's move from the investments and then look at some other aspects of the questions. And we trust that even offline, we'll try and address some of the questions and let the questionnaires also have the answers they wanted. So there's a question from someone who says, insurtechs are mostly startup companies that lack capital to develop. Aside sandboxes, does the regulator and industry intend to support with incentives to aid development? And I know this will go for the commissioner, acting commissioner.
We are regulators, and we don't have whatever for, but there are plans. We have plans for that. So I did talk about the tech platforms that we intend to organize from time to time, to bring the tech developers, the innovators, and the insurance players together. As another step to that, we intend to do the labs, the InsurTech labs. And the purpose of these labs is to bring the stakeholders together. So usually at the end of the lab, where we bring the final product, there we intend to have potential investors. We will have insurance companies that may be interested in taking over those products. So there will be partnerships. There will be people who have money and are willing to invest in innovative ideas that have potential. There are insurance companies that may be willing to take over some of these innovative, whether they are products or distribution channels, so that at that level, the partners will be there, and appropriate partnerships will be formed and taken on. So yes, we have plans to connect and match these partners, but the NIC itself, we don't have any direct support, but that is the support that we intend to put together, and we think it is going to be more effective than actually. So yes, that's what we are doing, and we have actually started last year. We did the InsurTech, and the finalists did get some amount. They got some partnerships to take their product to the market. There are some challenges, but yes, we are dealing with them. Once we start, we are going to make improvement until we can perfect. Everything is not perfect now, but as the saying goes, one before two. Once we've taken, we are one. Next step will be two. Next one will be three, and we'll be moving on. So yes, that's the plan that we have for bringing the insurtechs and the fintechs together to unleash the potential that innovation can bring to us.
Okay, thank you very much for that. Maybe let me ask Andrew, any perspective when it comes to tech, insurtech in the South African region?
So yeah, so I think we've got quite a vibrant fintech insurtech environment. I think it has spawned very much in partnership with insurers. So we've got the innovative licenses that they're able to lease an insurance license to the fintechs. So a number of the fintechs are distribution fintechs that borrow an insurance license and then scale themselves. And I think that creates an interesting avenue to entry that is sort of both beneficial to the insurance participants, so those who've got the skills at running the license, and the innovators from either distribution specialization or a customer segment specialization. So those are the ones that we have seen start emerging. And are starting to be quite impactful in markets that the incumbents are not acting in, but that they're still participating in. And I think the regulator is quite open to that. I think the point around a regulator not being a market developer is important. But I think the other thing, we have an advantage of some good private equity environments that are enabling private equity money to follow the fintech insurtech space. I think one area that is important in this, sort of gets labeled more broader fintech, is the payment space. I think one of the challenges that insurers face is the ability to get premiums or some kind of monetary flows from customers into their products as easy and seamlessly as possible, potentially in parallel to a banking system. And that's where the mobile network operators as a payments gateway are starting to come and partner quite extensively with the insurers to enable that to happen in the potentially unbanked markets, but also the underserviced markets in the broader financial services space. And I think we do lead the way globally for that, and that's the space a lot of the innovators are coming in at.
Okay, thank you very much for that perspective. Participants, my apologies because of the time that we have on our hands. What I'll do is I'll get in contact. I see a lot of questions, so the panel will sit and then we'll look at addressing most of the questions, and then get you the answers as you need. So I think the key discussions of today has been around the GDDEP in Ghana, risk-based capital, and etc. So at this moment, Kwabena, you are the host of this program. So we want to pick your words, be mindful of time before we get the final words of each of the panel members.
I think it's been, should I say, a very insightful session. Thank you, Commissioner. Thank you, Andrew. Giles just, without notice, came in and did some few words. But thank you very, very much. But I think with Deloitte, what we stand for and what we can do to help the industry, I think it's clear. One, we can help with your risk-based capital readiness assessment. I think although we are in the IFRS 17 journey, but it doesn't stop a company from carrying out a risk-based capital readiness assessment, because it is coming. Right after IFRS 17, we are heading towards the risk-based capital regime. So risk-based capital readiness assessment is something we can come in handy to do it for you. And we are also coming up with the 2023 Insurance Bootcamp in October, which will be from the 19th of October to the 21st of October. So we are inviting all practitioners to come on board so that you can learn more about the IFRS 17 and help you to implement smoothly. Deloitte we also do a lot around sustainability. So one, the regulator is about to adopt the ESG framework. You can also get in touch to deal with your sustainability reporting issue. So I think, okay, so there you have it. That is the flyer for the insurance training bootcamp 2023, and we have teamed it the last lap because this is basically going to be the last one. We've done it for a couple of years now, but this is going to be the last one. So practitioners, come on board, come on board. We are going to have fantastic speakers. Andrew, should I say it? Okay.
Andrew is going to be there, Kwabena.
I'm careful to say
So, okay, thank you, Kwabena. Thank you, Andrew. Thank you, Giles, and thank you, Mr. Andor, for your time. We scheduled to end at exactly 11:30, and it's 11:29. We want to thank each and every one of you participants for making the time for this webinar. We'll send you a feedback session form so that you can fill for us. And for those questions that are not answered, we'll do our best to answer them with the in charge, and then we will send them to you. We have your details, and so we will do that. Thank you very much, and we look forward to meeting you in other webinars, in the bootcamp, and then even at the part 2 of the INIC's insurance training. Thank you all, and have a wonderful day. Bye.
Thank you all. Thanks all.
Bye.
Bye.